Hello and welcome to the Casino Traders Group. We want to thank you once again for checking out our educational videos. We have so many on our site and on our YouTube channel. And today we're going to do part 2 of using trends. By saying this is part 2, that means you probably want to go back and check part 1. Part 1 was really talking about the long term and understanding how trends help us there. And today we're going to focus on intraday, how we can use trends on the intraday, day trader, futures trader, and to make sure that our trades are more successful. But first, we're going to just take a quick second review and say, why do we believe the trend is important? Well, again, on a longer term, it's very important because you want to know the direction. The trend is your friend, so you want to make sure you're trading in the long-term direction of the stock. Also, if you can effectively draw trend lines, you can identify support and resistance points, and again, help you identify great entry and exit points. And this is also true on the intraday time frame, which we're going to look at today. They can help you identify breakout points. And more importantly, if you're right about the trend, if you enter at the wrong time, in the longer time frame, if you're holding longer, it will work in your favor. However, if you're wrong about the trend and you enter at the wrong time, more than likely your trade is going to go against you. So to finish up our review of what we covered in video 1, and again, please go back and get the whole thing. I'm going over this really quickly. You can see we have our primary trend. This is the March low, and this is where we are today. Now, you have the purists who want to go from wick to wick. I just go through touches. So I went from the March low and drew our longer trend. And then we have our secondary, our intermediate trends, and you can see we had a nice little downtrend going on here within the uptrend, and there's obviously more. And so the purpose is understanding that if I get in the proper trend, this is an uptrend, and even with my timing, remember I say if you get in wrong timing on the long term, you're okay. So if you get in here, this is the wrong time to buy, but because the trend is in your favor, if you would have held long enough, specifically a month and a half, you would have been fine. So now that we have a basic understanding of how to use trend, or more importantly how to draw our trend lines, now we want to see how can we use trends to confirm a trend. Are we going up? Are we going down? Well, the best way to confirm a trend is using moving average. We understand trend lines. Obviously, if it's going up, then it's an uptrend. If it's going down, it's going down. But what else can we use specifically for our intraday traders, our day traders? How else can we use trends for our trades? Well, there's 3 things that we're going to look at. First of all is the direction of the moving average, the location of the chart, the price in relationship to the moving averages, and finally the crossover of using multiple moving averages. So first we have the direction. Just like a trend line, we want to identify the trend by taking a look at the direction of a moving average. If it's moving up, then it's an uptrend. If it's moving down, we have a downtrend. So in our example here, we can see the moving average, and right here it's angling up. So our trend using moving averaging is that we are in an uptrend. And one of the good things about moving averages, you have to define the moving average for each stock and test them out and see which one works best. But typically stocks like to pull back to moving average, test them out, and move in the same direction as that trend. So here we are, the moving average is heading up, so by our definition, we're in an uptrend. Now the second way is price location. Here we're looking at where is the price of the stock compared to the moving average on the chart. If the bar, because we use these candlesticks, is above the moving average, that's considered bullish, and if it's below the moving average, that is considered bearish. And we get buy and sell signals when the price crosses above and below that moving average. Again, you have to test out the moving average with the stock. In this example, we have a 100 moving average, and the stock did react very nicely on the long term with this moving average. And as the stock comes back and tests it and moves up, that's bullish. But once we cross below that moving average, that is now a bearish signal. And you can see here we kind of consolidated around the moving average and eventually came down, tested again, and went up. We also have a head and shoulders pattern in there. Finally, we talked about the moving average crossover. Here, we have a long-term and a short-term moving average. Some people like to use the 50 and the 100 or the 50 and the 200. Some like to use the 20 and the 50. Some like the 15 and the 65. There's multiples. I'm going to show you a couple in a second. You determine what works best for you. When the shorter time frame crosses above the longer time frame, the shorter, in this example, is the 50, the longer is the 200. When it crosses above, that's bullish. When it crosses below, the 50 crosses below the 200, that is bearish, and that's when we start to head down. Let's go ahead and take a look at some charts. So let's first start off with Google. And one thing we can see is what? Well, first let me say this. I have multiple setups when it comes to moving average. I have my short-term view and I have my long-term view. On my short-term view charts, I like to put the 5 moving average, which is yellow or gold, the 10 moving average, which is green, the 20 moving average, which is blue, and the 50 moving average, which is red. On my long-term charts, I really just like to have the 100 moving average. This purple is the 500 moving average, and then Google right now I have the 200 moving average, which is an orange that you'll never see. And I'll just put this little in here just to give me a reference where it is short term also. But so on the long term, it's the 100, the 500, and the 200. But when I start off looking at stocks each night, I start off, no matter what stock, it's got to get through this template first, which again is the 5, 10, 20, and 50 moving average. First thing we see here with Google is what? 20 moving average has been the hardcore resistance. The 5 moving average is the short-term resistance. It's pretty much been, support. Every time it breaks the 5 moving average, it basically comes down to the 20, holds up and comes back down to the 20. So if I'm trading this as a stock, really what I'm looking for is the moving averages are showing me that it's in an uptrend. The 20 moving average is, all of them are angling up. Every time it comes down to the 20, it bounces up. So I would be looking for this next time it comes down to the 20. But one thing we can see also on Google is what? Each time we hit the 20, boom, boom, kind of hit the 20 here, and we don't really get a boom. We get a, so it does look like it's getting a little tired. And look at the increase on the volume here on this move right here. But long term, you can see this is certainly in an uptrend. Switching over to Apple. This is what today is the 5th. So when you talk about December 4th and the 10% unemployment and the market take off and then died, here's the reason why we died. Look at Apple. When you think what happened yesterday and look at the volume, this is one of the reasons why the market ended not as good as it should have. We can see the 20 moving acted as support, and then bam, when we broke here, came down to the 50. Same thing here, when we broke the 20, came down to the 50. So what this is showing me right now, what are we doing? These short-term 5, 10, 20 moving averages are angling down. They're angling down, and we're sitting at the 50. That worries me a little bit about Apple as far as the long term. Now, the 50 can hold up and we can take off, but right now I would be concerned that all of these are angling down and getting ready to cross over the 50, which would really send this moving down. Amazon certainly has taken off since its earnings. Hasn't even come back to touch the 20 moving average, has it? It's basically been working off the 10 moving average. So this kind of goes back to what I was saying earlier. You got to find the moving average that works best for your stock. Finally, I want to show Goldman Sachs. And here, you want to know why we've been consolidating for the last 3-4 weeks? Here's why. Goldman Sachs financials have to lead the market, and we have no leadership, at least not to the upside. Now, I'm showing you some pause about Google and Apple. Goldman Sachs already has taken the lead down to the bottom side, so that certainly concerns me. But you can see uptrend, uptrend. Once they start angling down, Goldman Sachs started going down. And now that they all have crossed below the 50 moving average again, notice that we're really pushing down. Now that all three, the 5, the 10, and the 20, are below the 50 moving average. Let's switch to some intraday charts. As a futures trader, as an intraday trader, what I'm looking for is a coherence and agreement between the 15-minute chart and the 1-hour minute chart. On both charts, I have two moving average, the 5 and the 20. The 5 and the 20, and I want them to be in agreement. I want them both for uptrends. I want the 5 above the 20 angling up. For downtrends, I want the 5 below the 20 angling down. So when these two are in agreement, that is an excellent time to enter a trade. So I want to thank you for watching our video. We have a ton of videos on our website, blog.snotraders.com, and we also have a great future day trading plan that will help you continue your study of moving average and learning how to use the trend.